Well, it doesn't get bigger than this when you have Chris Wood of CLSA, someone who has predicted many bull and bear market cycles, right, and has pinpointed many mega trends in the past. Chris, welcome to India and thank you for joining us. Before we get into India-specific questions, Chris, let's start with your understanding of the worldview. Global risk of trade is back, central bankers are nervous, and there is a scare of deflation.
Well, yeah, no, we're still in this big, hello, thanks for the interview. We are still in this global deflationary backdrop where we still have central bankers in the developed world pursuing unorthodox monetary policies. Clearly, the narrative all year has been that the Fed is on the brink of normalizing US monetary policy. There is a growing possibility the Fed could raise rates in December. In my view, that will depend on the wage data in the next employment report for November. But ultimately, despite all the talk of Fed normalization, the reality today is the Fed has still got zero rates. The ECB has signaled it's going to expand quantitative easing, and there's a growing possibility of more quantitative easing or increased quantitative easing in Japan. So we are a long way from normalizing monetary policy.
Chris, for the longest time you've argued that Fed will not increase rates, and my compliments, you've got it right. But the current batch of economic data from US seems to be pointing to some degree of economic recovery. Since US Fed is very data dependent, do you think they could use the current data points to increase rates?
No, well, although my base case remains no rate hike this year, I have to admit that the possibility of a rate hike has definitely increased in December. And the key reason for that is not the better job data. The key reason is the wage data. So the last data point that came out showed the biggest increase in average hourly earnings growth since 2009. It rose 2.5% year on year. So if that wage strength is repeated next month, then my guess is that even Mrs. Yellen will raise rates. But if the wage data weakens next month, then I believe she won't. So to me, it all hangs on the wage data.
Chris, if I look at the recent experience, all the central bankers are committed to print more money, starting from BOJ to ECB and Bank of Japan. And clearly this loose monetary policy has not kick-started global growth. The global growth is still anemic. So do you think central banks, they should take cognizance of the fact that a zero interest rate regime is not starting growth back?
Oh, no, well, I think that's absolutely correct. My personal opinion is that these quantitative easing policies are misconceived. My view is the zero rates are negative for growth. My view is that quantitative easing increases deflationary pressures. So my view is firmly that quantitative easing has the precise opposite effect of what is intended. But that's obviously my view. There is no sign that the people running the G7 central banks agree with me. All the evidence is that if economies decelerate, they will do more quantitative easing, not less.
Chris, even though so much of global liquidity is floating around and US 10-year paper is just north of 2%, are you a bit surprised with the current risk-off environment, starting with global equities to global commodities? All major asset classes are at a multi-month low. Some of them are at a multi-year low.
Sorry, I missed that. On the commodities, you're asking on the commodities?
No, I'm saying that every major asset class, Chris, as we speak, is at a multi-month low, starting from oil to gold to what is happening in emerging market stocks.
Right. So on the commodities basically started to correct again from 2011. But the key thing that's happened in the last year is oil has joined the commodity bear market. In my view, oil, particularly in the energy complex, still has significant downside risk because US oil production has barely started declining yet. We have the growing threat from the alternative energy space. The big catalyst, though, for oil price decline was the change of policy by Saudi Arabia this time last year. So unless Saudi Arabia changes policy again, in my view, it's a matter of time before oil breaks $40. That will be a significant event because the consensus is assuming that $40 oil will be the bottom.
So what will be the implications of a further crack in commodity prices? Geopolitical tensions have already surfaced up. Sovereign funds are already, pulling out money. They are going low on their investment. So do you think the regime in next 12 months and next 18 months could change dramatically and money will move from commodity producers to commodity consumers?
No, that's what's happening. But at the beginning of this year, there was huge optimism that the US consumption would accelerate because of the decline in the oil price, because the view was that would lead to more big positive impact in US consumption. Actually, US consumption, while it's been okay, has not improved in the way expected because of the oil price decline. So what people missed on this oil price decline is that the immediate impact is negative, because the immediate impact is deflationary on those people producing oil, because they just have a complete loss of wealth because the oil price goes down, and it's doubly deflationary if they borrow dollars against that resource-related income. However, the benefits to consumers of oil, be they American consumers of oil energy, European or Indian consumers of oil, are indirect. So while it's a positive indirect benefit, the much more immediate impact is the negative deflationary shock on the oil producer. And as I say, in my view, the risks are overwhelmingly that oil goes lower, not that it has a sustainable bounce.
You are extremely bullish on gold. Now, gold tends to do well in an inflationary environment. It is considered as the best in the natural hedge against inflation. But in a deflationary environment, can gold do well?
I view gold as essential life insurance for people who have portfolios who want to hedge the systemic risks created by this Western central bank, well, it's not Western central banks, it's G7 central banks monetary experiment, which has been going on since 2008, otherwise known as quantitative easing. Someone asked me this week at this conference, what's the bubble in the world right now? The bubble in the world right now is not a particular economy or a particular asset class. The bubble is in the G7 central banks, because markets continue to hang on every word uttered by the head of the Fed or the ECB or the BOJ. Markets are not yet questioning the credibility of these people running these central banks. But as you just noted, actually these QE policies are not being effective and getting growth going again. So the key question is when and if do markets question central bankers? So I'm not owning gold because I think inflation is about to pick up. Actually, the velocity data, velocity continues to decline in the US. Velocity is at a 6-decade low in the US. Velocity continues to decline in Europe and also in Japan, despite the QE policies. So while monetary-based narrow money supply is growing under QE, we won't get inflation picking up unless velocity picks up. And in my view, velocity will only pick up if there's a real questioning of the central bank credibility. So I'm not owning gold because I believe inflation is about to pick up. I'm still in the deflationary camp. I'm owning gold as insurance for the chaos that will happen if financial markets suddenly start questioning central bankers. So then the next question is, when would that happen? That's impossible to predict, but one point it could happen is if at some point in the next few quarters the US resumes QE, because that will be so contrary to the current consensus outlook. Current consensus outlook is that US monetary is probably going to normalize and we're going to go back to normal. My view is if they start to try and raise rates, the financial markets will protest, then the Fed will reverse course and then do more QE. At that point, I would expect gold to rally.
Chris, in the past, you've argued that India is the best structural and the best relative stock market. But even the oil prices are down by more than 50% in last 1 year. Inflation has got crushed. Indian markets have given flat returns in last 1 year. Why is that?
Yeah, basically, I'm not too surprised that I'm still a big overweight in India, but I would have to admit the investment case for India right now in a global portfolio is much better from a relative standpoint than an absolute return standpoint. So India is a good relative story, but it's not a great absolute return story. In fact, this year, my formal view has been that Indian 10-year government bonds are a better investment than Indian equities. What's happened in the Indian stock market is we continue to have earnings downgrades, which is a negative, but the reason why the equity market has not fallen more despite the earnings downgrades is that the negative impact of earnings downgrades has been offset to a significant degree by the fact that the cost of money is going down and you've had 125 basis points of monetary easing. The key fundamental problem for the Indian stock market is that we have not seen a new private sector-led capex investment cycle pick up. And as of today, there's still no real sign of a capex pickup. And my key explanation for why there hasn't been a capex pickup is the legacy NPL issue in the Indian banking system stemming from the last infrastructure cycle. Maybe about 15% of total loans in India are stressed in one way or another. And in my view, my major criticism of the Modi government, in fact probably my only real criticism, is a lack of urgency shown thus far in addressing this legacy NPL issue. Because if it is not addressed, the economy will continue to underperform, the investment cycle will be delayed, and monetary easing will be less effective than it would otherwise be, precisely because the banks are carrying this have got this asset quality issue.
So, what do you make of the latest economic reform which was announced just in and around the Bihar election? A, fixing discoms, and B, opening up of 15 sectors. Let's discuss both these factors. Fixing of discom is a legacy problem. Do you think the plan announced by the Modi government and the current administration is good enough to take care of the legacy issues?
Well, I have to admit I haven't looked at this in real detail, but I think it's very encouraging that the government announced this scheme. From my initial look at this scheme and discussions this week, this scheme seems to have something that previous efforts to clean up the SEB distribution issue did not have. That is, it involves both sticks and carrots. So to me, this is a positive development, and it follows on from the other positive development of the past year that coal production has increased. So personally, I'm giving that the benefit of the doubt for now. And clearly, these reforms on FDI are positive too. But to me, the one thing missing from the Modi government is a greater sense of urgency on dealing with the assets in the bank, the problem assets in the banking system. Clearly, if the state electricity boards are cleaned up, that will be big progress. But what one would have liked to have seen is some more urgency shown in terms of putting bad assets into a bad bank, separating the bad assets from the rest of from the state-owned banks, and seeing some more urgency displayed in recapitalizing the state-owned banks. Because the state-owned banks, while they continue to lose market share to the private sector banks, are still 70% of the system, I believe.
Chris, for the longest time, you've made a case to buy into Indian private banks, and some of your key recommendations in your model portfolio are HDFC Bank and IndusInd Bank. Do you think private banks or Indian private banks have a long way to go, even though they are a consensus in the crowded trade? Do you think this crowded trade will make money?
Well, they may trade sideways for a period, but the reality is I'm keeping my weighting in private sector banks, because in my view they remain a structural story. In fact, I've always had Indian private sector banks in my long-only Asian ex-Japan portfolio since I began it in late 2002. So I've always had Indian private sector banks. I believe they're a structural story. So far that view's been correct, and they continue to take market share from the state-owned banks. So that's a very positive bottom-up story, but there's There's a macro issue right now, which is the legacy NPLs, which are predominantly in the state-owned banks.
Another recommendation which has worked like a charm for you and for investors is Maruti, India's biggest passenger car company. Maruti has been a ranked outperformer, but given that Maruti is now trading at 30 times and it is trading at a significant premium to global car companies, do you think the run-up in Maruti is about to get over?
It may be, but I've got no intention to change it, frankly. Because again, it's worked. While it's worked, I don't see any compelling alternatives. So basically, my portfolio in India, I've got a huge weighting in India in my long-only Asia ex-Japan portfolio, which is about 25 stocks. But my portfolio is basically low beta. It's expensive, low beta quality stocks. I don't want to jump into high beta, cheapest, more cyclically geared stocks, precisely because I don't see clear evidence as yet of a pickup in the investment cycle.
Chris, the fact that you are betting on financials and you're betting on home finance companies, consumer finance companies like Bajaj Finance, can I safely assume that you are bullish on Indian consumer coming back or consumption demand coming back?
Yeah, well, I'm most positive on, to me, where you want to be in an equity portfolio in India right now is more focused on companies, providing goods and services to the urban consumer, because in my view, the urban consumer is in a better situation than the rural consumer, and the urban consumer is more geared into the declining interest rates, which we're seeing in India with 125 basis points of monetary easing so far this year, and my view, more easing to come next year. Whereas the rural consumer is suffering the extended hangover from the cuts in subsidies under the Modi government, which has had the beneficial consequence of helping to lead to a significant decline in inflation. But these reduced subsidies have clearly led to a hangover in the rural economy, because demand was artificially stimulated in the rural areas by aggressive subsidies under the previous Congress government.
I noticed that you don't have too many large cap IT stocks and pharma stocks in your portfolio. Now, you mentioned the word quality. Now, in general, Indian IT companies and Indian pharma companies are good quality companies, decent management bandwidth, zero debt, high return on capital, strong equity ratios. So why are you avoiding that end of the market?
Well, I frankly should have had something, but I mean, if I had a big portfolio in India of 40 stocks, I would definitely have these stocks in the portfolio. I've just got a my basic Asian portfolio has always primarily been focused on the domestic demand story. And that's why I've structurally favored the private sector banks. But there's one other issue actually, apart from the investment cycle I should have mentioned, there's another issue which I think is curtailing the pickup of an investment cycle in India, and that is clearly that the residential property market in India is not in great health. So I think the combination of the lackluster residential property market and the legacy NPL issue in the banking system is the biggest issues right now in terms of not having a healthier domestic investment cycle.
So are you of the view that real estate prices in India are high and they need to come down?
Well, my understanding is transactions in the real estate sector, residential, have declined significantly. So I think there's downside risk on the property market in India. So on the residential property market, I'm much more sanguine on the commercial property market.
So Chris, if you feel that real estate transactions have come down, which they have, and Indian residential real estate market is expensive, it's not a bubble, but it is expensive, why are you bullish on home finance companies? HDFC, Grah Finance, they've been part of your portfolio for a long time and they're still part of your latest portfolio.
Yeah, well, that's a long-term hold, but the compensating factor there is hopefully lower rates and more mortgage demand. But in the short term, they wouldn't be my top picks.
Chris,
but I think the compensating factor is that I'm expecting further rate cuts.
How far are
But
we?
I wouldn't want to own leveraged property very aggressively leveraged property developers.
Okay, so Chris, looks like you're still of the view that one should really avoid going down the ladder. Stick to quality, even though Indian quality stocks are trading at a premium, their P multiples and book values are at a historic high. One is better off owning that end of the market. There is no point in chasing stocks just because they are cheap.
Now, I'm still of that view, but obviously the key thing we've got to watch out for is an inflection point in the private sector capex investment cycle. But I have to admit, because I've only been here 2 days, but so far I'm not getting the sense that we're about to get liftoff on this private sector capex cycle, and I'm not getting that view from the corporates presenting at this forum. The key missing link to the Indian story right now is continuing lack of urgency displayed by the current government to address this legacy NPL issue, which was a problem before they took power, and that's my biggest surprise.
Chris,
because if I'm running the Indian government and I want to generate investment-driven growth, then I need to sort out the banking system.
Okay, that's one area which needs to be addressed. Chris, historically, Indian markets have always traded at a premium to other emerging markets, and of late, Indian markets have enjoyed what would be called as a Narendra Modi premium. Given that there seems to be an opinion and there seems to be some disappointment on the government reform side and the pace of reform, and you also rightly said there is no urgency which has been displayed by the current administration, do you think Indian markets will lose out and the Modi premium could evaporate?
No, look, there is a risk of that, but to me that's not inevitable, because as you rightly noted, we've seen some policy initiatives in the last week or two. So personally, I'm hoping we don't get a huge derating. While the investment cycle is not picking up, it's not collapsing either. From a relative standpoint, India is still looking attractive. Foreign investors will be reluctant to sell the quality companies they own. And the other interesting point in India is that we've had domestic mutual fund inflows into equities ever since this new government came to power. And that's a positive development. But personally, I continue to think Indian government bonds are a better risk-reward ratio today than Indian equities.
Why do you say that, and why do you feel that, Chris?
Because the 10-year government bond yield is a high yield. You have still tight monetary policy here. You have a central bank with credibility, and that's why so far, year to date, foreigners have invested more money in Indian bonds than they have in equities.
Chris, so let me get some closing comments from you. What is your 12-month view on India, 3-year view on India, and 5-year view on India?
Sorry, I missed that. What's my 12-month view?
12-month, 3-year, 5 years. I can drop in 10 years also.
Well, no. Well, basically, frankly, the market will probably continue to trade sideways until we have evidence of an investment cycle pickup. That's my key point. When we get evidence of an investment cycle pickup, there's very significant upside in the Indian stock market. But my base case is that the earnings downgrades, we've still got a risk of earnings downgrades. Hopefully we're coming to the end of that process, but the earnings downgrades can be offset to a significant degree by further monetary easing. So at the start of this year, I was saying 200 basis points of monetary easing minimum in 2015 and 2016. We've so far had 125 basis points of monetary easing, which is probably more than most economists were expecting at the start of the year. Personally, I think there will be a minimum of 75 basis points more easing before the end of 2016, and my guess actually there'll probably be more easing. So I think that those lower rates are to a certain extent offsetting the earnings disappointments.
Chris, what?
But in terms of real upside for the stock market, we need an investment cycle.
Well, that's the need of the hour, and let's really hope that the investment cycle in India picks up. Thank you for your time, and thank you for accommodating this interview request, Chris, and enjoy your stay in India.
Thank you very much. Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.